We've all heard of the S&P 500, but how many of us really understand this Wall Street institution? What exactly is the S&P 500, and should you put your money into it? Hello and welcome to Alpha Finance. This is the channel to watch if you want to learn more about personal finance, investing and cryptocurrency. However, before I get into the topic, do me a favor, subscribe and hit the like button because it really helps with the YouTube algorithm. Thank you, and now let's get into it. Today we're going to pull back the curtain on the S&P 500, so you can become a sophisticated investor capable of talking stock with the best of them. Stocks of 500 large-cap U.S. corporations make up the S&P 500, an index of the stock market. It is symbolic of the stock market as a whole since it details the opportunities and threats faced by the largest corporations. It is the standard against which all other investments are evaluated in the eyes of investors. The first two financial firms' initials, S&P, stand for Standard & Poor. This gold standard exchange was formally launched on the market on March 4, 1957. When calculating market capitalizations, the S&P is a float-weighted index, which means that the number of publicly traded shares is taken into account. Since the S&P 500 is an index rather than a security, investors can only indirectly benefit from its performance by purchasing shares in one of the numerous funds that use it as a yardstick. As of January 2022, the S&P 500 had returned an average of 13.9% annually during the preceding decade. How does the S&P 500 really function? Stock prices in the S&P 500 are correlated with the market capitalization of the component companies. The market capitalization of a business is the sum of the current prices of all of its outstanding shares of stock. If a company's market value is $100 billion, then it will be represented by 10 times as many people as if its market cap were just $10 billion. As of January 2022, the overall market cap of the S&P 500 was $34 trillion. Large-cap stocks are overrepresented in the S&P 500 compared to the Dow Jones Industrial Average. The Dow Index follows the stock prices of 30 leading corporations across many sectors. Nearly a quarter of the whole value of the U.S. stock market is held by its market capitalization. The Dow Jones Industrial Average is universally cited as a proxy for the health of the global economy. And compared to the Nasdaq, the number of technology-focused companies in the S&P 500 is much lower. While just 28% of S&P 500 stocks were invested in IT as of June 2021, 55% of Nasdaq stocks were. Despite their distinctions, these stock indices all tend to move in the same direction. If you simply look at one indicator of the stock market's performance, you may still get a sense of the market's overall health. This is all very interesting, but you're probably wondering how can you make money with the S&P 500? To get the same return as the S&P without actually buying shares, you can do what many retail investors do: invest in an index fund. Alternatively, you might invest in companies that are included in the S&P 500. When you want to know how the U.S. economy is doing before anybody else, go no farther than the S&P 500. Whenever there is optimism about the economy, traders are more likely to purchase equities featured in this exchange. Now, since the S&P 500 solely tracks U.S. equities, it may be useful to keep an eye on other markets, especially developing economies like China and India, to get a more complete picture. Keep in mind, commodities like gold may usually maintain their worth for longer periods of time than stock investments, so you might well want to allocate a portion of your portfolio to this kind of asset. Tracking bond prices, which are like IOUs from the government and businesses, together with the S&P 500 will also give you a better reading of the state of the economy and help you make more informed investing decisions. Lucky for you, credit ratings for bonds are also provided by Standard & Poor's. Bond prices often go in the opposite direction of stock prices, however this is not always the case. Bond and stock values can experience periods of volatility. Is the S&P 500 a secure investment? Absolutely. It is still a good idea for long-term investors to put their money into the S&P 500, even during a bear market. When the Standard & Poor's 500 index falls to levels indicative of a bear market, investors and media outlets take notice. Warren Buffett is a firm believer in putting one's money in low-cost index funds that follow the S&P 500. Warren Buffett has placed his money where his mouth is. From January 1, 2008 through December 31, 2017, he staked a wager on the S&P 500 outperforming a portfolio of 5 active funds. The Oracle of Omaha was spot on, of course. A mere 36.3% net return was achieved throughout the 5 funds. S&P 500 index returns were 125.8%. Nevertheless, recession worries make investing unpleasant when equities are down. The value of your S&P 500 investment may go down next month or perhaps next year. With a 10-year holding period, the index produces positive returns around 94% of the time. Your chances of success increase dramatically. Moreover, a 20-year investment in the S&P 500 has never resulted in a loss. Of course, a further decline in the S&P 500 index is possible. So it's natural that you're debating with yourself whether it is better to invest now or wait for the stock market to reach a bottom. If it were feasible, we'd all time our investments for the greatest possible price. However, even the most seasoned investors do not know when we've reached rock bottom. Rising inflation and interest rates are persisting. Meanwhile, the fighting in Ukraine shows no signs of abating. Unfortunately, we likely have not reached the bottom of the market yet, and this bear market will continue for months, if not years. However, don't let that deter you from buying index funds to track the S&P 500. Your investment should be less risky the longer your time horizon is. Save consistently even during down markets, since history shows that doing so will pay off in the long run. The power of compounding may work in your favor over a longer holding time. If the market returns the historical average of 10% each year, your investment would double in around 7 years. For example, if you invested $100 per month for 30 years at this rate of return, you would have around $210,000. A future you would, no doubt, appreciate a lot. But you've got to face the possibility that your returns could remain down in the dumps, and you might even incur a loss. The S&P 500 index isn't a way to make $1 million overnight, even if you hit a home run. Instead, you'll be investing regularly in it and looking forward over the long run, since that's what decades of statistics say will pay off. And no, this is not investing advice, this is just someone passionate about financial freedom talking to himself on the internet. Don't get it twisted. One further drawback of index funds is that they are, well, average. They will never be top performers, but picking the biggest gainers year after year is very difficult, which is why Ray Dalio gets paid the big bucks. Now, many investors are content with only adequate profits. But this kind of investment strategy may be too safe for the ambitious investor who wants to swing for the fences and retire in his mid-30s. For those of you that want the reliability of an S&P 500 index, it's essential to allocate a certain amount of money each month. Then, regardless of what happens in the stock market, you may begin dollar-cost averaging by investing that amount every month. However, there are 2 qualifiers. Prior to getting started, you should pay off any high-interest debt, such as credit cards. The average interest rate on a credit card is close to 15%, which is more than twice as high as the profits investors may anticipate from the stock market after accounting for inflation. Second, try to save enough money to cover your expenses for at least 6 months in the event of an emergency, since this will safeguard your finances in the event that you need cash while the stock market is down. When the market is down, you may get more for your money, so if you've done those 2 things, now is as good a moment as any to dive in. If you qualify for a Roth IRA, you may want to consider investing in the S&P 500 to lock in tax-free gains. It's a good opportunity to put money into the S&P 500 if you don't mind waiting. Maintain your composure and know that money creation is a marathon, not a sprint. That's all for today's video. What do you think? Do you feel like following the S&P 500 is the smartest investment strategy around for the average investor? Or do you believe there are smarter approaches available, like just copying whatever Michael Burry or Warren Buffett does? Please leave any thoughts or opinions down below in the comments. They always create an illuminating conversation. And as always, thanks for watching.